It was October 2010, and the world was welcoming the launch of Instagram. Yeah, I know, Instagram has been alive and kicking for over 10 years. At the same time, Megan was 21, about to start her first job in LA as a business analyst. She had discussed with her dad about how she would continue living in the family house and hoping to save some extra money in those first few years of being a working class adult. To Megan, she knew she wanted to invest everything she possibly could. Based on her dad's advice, Megan decided to invest in Vanguard 500 index fund investor shares, an index fund created to track the performance of the S&P 500 index. Over those 10 years, she was able to raise her monthly contributions to $4,000, 10 years from when she started. Through dogged consistency and discipline, she has made a significant difference in her financial life. Now at 30, riding the average return of the S&P 500 index over those years, which was 13.6%. Assuming she has averaged a monthly contribution of $2,500 per month across those 10 years, Megan would have at least $600,000 to her name in 2020. For her, this is the beginning of financial independence. Hi, hello, ni hao. How's it going, everyone? My name is Chris, and welcome to my channel where we discuss personal finance, investing, wealth management, real estate investment, all-round self-improvement. For those of you who are new to the channel, and to those returning, you're both equally welcome. As highlighted in the previous part of this series, I'm very passionate about investing. Now, if you haven't seen those videos, I do highly suggest that you actually start from there. So here's the truth. Every one of us is continuously looking for ways to improve on what we already know. The same applies to personal finance and investing in general. With that in mind, we can all learn from each other. So feel free to share your ideas in the comment section. With all that said, let's jump right into it. There are various types of investment vehicles ranging from individual stocks, index funds, even bonds. Let's briefly discuss stocks or equities as they are sometimes called. Now, stocks or equities represent ownership in an entity or a company and are traded on the stock exchanges or equity markets. Now, equity market is a broad term used to describe many stock exchanges around the world that match buyers and sellers of stocks. That stock market is somehow always going up and down. Yeah, that's the one. It is a marketplace for stocks, and this is where stocks are held and sold. It shows the different shares of company ownership and how they're performing overall. The interesting thing about the stock market is that it is generally controlled by investor emotions. If there's breaking news about how the government will be looking into a particular company's handling of customer data, all of a sudden people are going to start worrying that something significant would be discovered at the company. This throws in a hint of fear and worry for that company's stock in the market. When an investor buys ownership stake in a company, it's actually done in the expectation of receiving a share of the profits in the form of dividends, or also benefiting from the growth of the originally purchased stock, or even both. Let's take Microsoft for example. You can easily buy Microsoft stock, which means you actually own a fraction of Microsoft. So as the company grows, your shares in the company are expected to grow in value too. To be really frank with you, finding a company that's actually worth investing in takes a whole bunch of research to adequately understand the business. You would need to know the company's competitive advantage in the market capitalization, earnings and cash flow, price to earnings ratio, debt to equity ratio, is the company buying back its own stock, the composition and effectiveness of the company's leadership. There are so many things to consider, and it takes a super patient person to perform this research. It would also take some level of investing knowledge and expertise to adequately pick out those good ones, hence the true value of the 3-fund portfolio approach. For new or beginner investors, the 3-fund portfolio strategy is an investment approach where you create a portfolio that only contains 3 assets. A 3-fund portfolio only uses basic asset classes. When I say basic asset classes, I'm actually referring to 1, a domestic stock total market index fund, 2, a bond total market index fund, and 3, an international stock total market index fund. To begin with, what is an index fund? Now, an index fund is a type of mutual fund that mirrors a particular market index. These market indexes can be the S&P 500, the Dow Jones, the S&P Toronto Stock Exchange, or the FTSE 100 in the UK. The index fund essentially contains a small fractional representation of a total market. As mentioned, it is a type of mutual fund with a portfolio designed to match or track the components of a financial market index of choice. It provides that broad market exposure and low portfolio turnover. For example, an index fund based on the S&P 500 will give you exposure to hundreds of the country's largest companies, in this case the US. This will track the stocks issued by the top 500 publicly traded companies in the United States. Companies like Apple, Amazon, Alphabet Inc., Facebook, Tesla, Microsoft. Since this does not focus on individual stock but invest on multiple companies, all your investing eggs are not in one basket. We also have ETFs. They are similar to index funds and both are commonly used by passive investors and don't need to be actively managed. They are very popular among first-time investors who aren't able to drop a significant amount of cash into a fund all at once. The biggest difference between ETFs and index funds is that ETFs can be traded throughout the day like stocks, whereas index funds can only be bought and sold for the price set at the end of the trading day. Both index funds and ETFs cost less to manage than your traditional mutual funds, which usually has a higher management expense ratio. usually above 2.0%. For example, Schwab's S&P 500 index fund has an extremely low expense ratio of 0.02%. Fidelity 500 index has an expense ratio of 0.02%, while Vanguard's total market index fund has an expense ratio of 0.04%, meaning that you pay just 40 cents per year for every 1,000 invested. Index funds and ETFs can be bought and sold directly through number one, index fund providers, investment advisors, online brokerages, and even robo-advisors. In the US, making use of your retirement accounts, the best diverse, low-cost, and low-risk index and exchange-traded funds can be bought through Vanguard, Fidelity, Charles Schwab's, and Robinhood. There are also great robo-advisors available for use, including Betterment and Wealthfront. Now, when it comes to purchasing ETFs and index funds, Vanguard is the most popular option because they are the originators of the index fund. They offer extremely low cost and even free index fund that cost you nothing to buy and almost nothing to maintain. As always, please make sure you conduct your own research. I'm by no means telling you what to do. I'm here providing information to help you kickstart your research. Now, in Canada, if you want to invest in passive index funds or ETFs, there is Wealthsimple Trade, there is Quest Trade, there is TD Direct Investing where you can purchase E-Series funds. There is also BMO's Investor Line. They're all great options. There are so many of them out there. Now, I'm not sponsored by any of the organizations mentioned, but personally, I opened my retirement investment account using the online brokerage and wealth management firms Questrade and Wealthsimple. Now, Questrade allows holding of US dollars in registered accounts. They both offer TFSA and RRSP retirement and investment accounts. Online brokerages tend to be easier and cheaper option. Some even offer 0% commission trading in Canada. For a long-term goal like retirement, investing with an online brokerage or a robo-advisor makes the most sense because a robo-advisor will choose low-cost index funds and rebalance your portfolio, keeping it in line with your investing preference and timeline. This is usually called a lazy portfolio because it requires very little maintenance. You're able to spend way less than a couple of hours annually to monitor and adjust your portfolio, meaning that you can also avoid the additional advisory fees and cost of having someone else monitor and manage your portfolio for you. This approach is completely unsophisticated and perfect for the person who wants to make use of the least amount of effort in putting together an investment strategy. Now, before exploring the 3-fund portfolio option, you need to know the following. 1. It is very essential to fully understand your financial goals and objectives. You would also need to know what brokerage you want to work with. You need to understand your risk tolerance because this will inform the asset allocation approach you would prefer. Now 4, are you more interested in a long-term or a short-term approach? Well, long-term is always more advisable. Now, once you decide on this, then you can choose your asset classes. As previously mentioned, they're usually made up of 1, domestic stocks. For example, if you're based in the US, this would be US-based stocks like those within the S&P 500 index, Dow Jones, or any other one with potential listed on NASDAQ or New York Stock Exchange. Now, if you're in Canada, this can be Canadian stocks contained in the S&P Toronto Stock Exchange Composite Index. Then you have domestic bonds. Now, if you're based in Canada, a very great example would be iShares Core Canadian Universe Bond Index ETF. For international stocks or the rest of the world equities, Vanguard has one for emerging markets. This is the Vanguard Emerging Markets Stock Index Fund, also known as VFINX. The reason why this is such a brilliant approach is that a great investment strategy must be 1, well diversified, 2, considerate of short and long-term costs, and most importantly, it must be low risk. With this approach, your portfolio investment bucket is filled with small fractions of thousands of stocks, practically eliminating the risk of not being diversified enough. Also, because of the diversified nature, index funds remove the risk of owning individual stocks. The fluctuations will be a lot less than owning an individual stock since they are not actively managed. The best part of index funds is the low expense ratios. Fidelity, for example, has an index fund that literally has no expense ratio at all. The icing on the cake is that rebalancing is very straightforward. You set a predetermined asset allocation. In this situation, when the asset classes no longer represent your preference, then you simply adjust your portfolio. The actual allocation across each asset class can vary according to your financial goals, plan, and risk tolerance. Say you want to be on the aggressive side, you can consider an 80-20 portfolio, 65% stocks, 15% international stocks, 20% bonds. This is a reasonable approach because when the stock market goes down, bond prices usually go up. It will serve as a safety net for you. Or maybe you want a more moderate approach that has equal allocation across the portfolio. 33% stocks, 33% international stocks, and 33% bonds. Now, if you're super conservative, then a 20-80 portfolio might work for you. 15% stocks, 5% international stocks, and 80% bond. If you're young and in the initial stages of your investing journey, you may want to opt in for a portfolio that is heavily weighted in stocks. There's no better time to be more aggressive than when you have time on your side. But the older you get, the more you should consider reallocating to more stable and conservative investment vehicles like bonds and guaranteed investment certificates, things of that nature. You can make use of the 100 minus your age formula to come up with a rough idea of what might work for you. For example, if you're 30, then 100 minus 30 will give you 70. Hence, 70% mix of domestic and international stock will do just fine for you. On a monthly basis, if you consistently buy into these funds and you do this for years to come, then you're going to ride out the average returns of the market. With this approach, you will not be trying to predict the future like a fortune teller by identifying that one stock that would win the race or rule them all, or even trying to time the market. You would instead be placing your confidence on the historical market performance. Here are some very popular US and Canadian index funds to consider. However, depending on the platform you make use of and your country, some might be available to you, while some might not be available to you. To begin with, we have the Vanguard Total Stock Market Index Fund. This is the largest stock index fund you could buy. It captures the entire US stock market. Buying this will ensure you are well diversified. There's also Fidelity Zero Large Cap Index, Fidelity S&P 500 Index Fund, Vanguard 500 Index Fund, Vanguard Growth Index Fund. This index fund has a 5-year annualized total return of 21.57%. There's also the Vanguard S&P 500 Index ETF, the Vanguard Dividend Appreciation ETF. This tracks the Nasdaq US Dividend Achievers, which is a collection of highly profitable large cap stocks with 10-year consecutive years of steady dividend increases. There's also the Vanguard Total Stock Market ETF, the Vanguard FTSE Canada All Cap Index ETF. For popular US and Canadian bond funds, you have Vanguard Total Market Index Fund, Schwab's US Aggregate Bond Index Fund, Vanguard Total Market Index. This is great for passive investors who want exposure to the entire US bond market. It is the largest bond index fund in the world. It's a collection of corporate bonds, US Treasury bonds, short, intermediate, and long-term bonds. You also have the Fidelity US Bond Index Fund, Fidelity Total Bond Fund, the iShares Core Canadian Short-Term Bond Index ETF, Vanguard Canadian Short-Term Bond Index ETF. There's also the iShares Core Canadian Universe Bond ETF, and then finally the iShares Canadian Bond Index ETF. So once you have all those figured out, in order to further diversify your portfolio, you need to add international index funds. This will help you navigate the market fluctuations. This section of your bucket will cover the emerging and growing markets. This can include the Vanguard Developed Markets Index Fund Admiral Shares, Vanguard Total International Index Fund, Fidelity Zero International Index Fund, the Schwab International Index, Fidelity International Index Fund. Between all these funds, you should expect to see a 7 to 10% return each year, with dividends reinvested accounting for inflation. This is wealth building through completely passive income. Now, here's what you need to know. Say you invest $2,000 a month from the age of 18. By the age of 45, that could potentially be worth millions of dollars. I know I've presented a situation where everything seems like it will go well and smoothly, but with anything that has its pros, it also has its cons. Because this investment approach is not actively managed, you are really at the mercy of the markets you're invested in. This means that if you're looking to build your wealth aggressively, there would be other specific investments or individual stocks that can actually rack up more money for you over the years. However, index fund investing is meant to be a long-term strategy. So if you're looking at making that very quick money, this is definitely not for you. Remember Megan's story, or even Monica's story. She was committed to this for a very long time. Here's what I think. Hold your investment for at least 10 years. If you can go for 20 years, awesome. However, this will heavily depend on where you are in your life and your personal situation. If you can start putting away and investing $250 per week to an investment account, you are setting up a very comfortable future for yourself. When it comes to investing, the earlier you start making time and compounding work for you, the better. This will help your money grow exponentially. Now, the investor who starts investing a few years earlier can possibly make hundreds or thousands or even millions more depending on your monthly investment. The best time to start investing is in your teenage years. The next best time to start is now. Whenever now is, all you just need to do is commit to a dollar cost averaging strategy. This is where you basically commit the same amount monthly to buying these index funds. Just keep buying in over and over and over again. There is also nothing preventing you from increasing it slowly when you're able to do so. With this approach, there will be no need tearing out your hair when the market starts its usual short-term fluctuations. Do not attempt to time the market. Now, numerous studies out there clearly show that the more you buy and sell stocks and try to time the market, the lower your overall return is. It's simple. You buy when the market goes up, you also buy when the market goes down. If you've learned anything from last year, it is that the market will go down and the same market will also go up. Whatever the case is, just keep buying into these index funds. Thank you for taking out time to watch the video. If you actually like the content and found it valuable and would like to see more of it, please hit that like button so the YouTube algorithm can also recommend it to other individuals that might find it helpful. If you have thoughts about the video, please engage me and the community in the comment section. Please subscribe and hit that notification bell so you can receive other useful content from this channel. Feel free to add me on Instagram and other platforms. I'll be posting content there daily. Thank you everyone, and until next time, keep putting your future self first.